And when you have certain counterparties that have offered promissory notes in synthetic form, I think we're going to see a few big players around the world, maybe this year or next year, who won't be able to deliver the requisite gold and silver. The gold can't be found. So, there was a request for 40 tons, and the most some of the parties could come up with is only 5. So there is a global race for physical gold and silver to meet these record deliveries on the COMEX, and the market is running dry of physical.
Welcome back to Liberty and Finance. We have 2 returning guests. John Adams is a professional economist from Australia, and Andy Schectman is the CEO of Miles Franklin Precious Metals Investments. John and Andy, thanks for joining us to talk about a serious matter tonight.
Thank you very much.
Thanks, guys. Good to see you down again.
We're catching you both this Sunday, August 23rd, 2020, because this was how we could get our down under and up here in the U.S. time zones aligned, so we're glad to capture this moment. John Adams has been doing some investigations over the past couple of years with his partner Martin North from In the Interest of the People about some serious concerns and serious questions about the integrity of gold holdings in Australia, involving the Royal Bank of Australia, involving people who, like most would, believe that they have holdings that are on account there, but that there are serious concerns for ordinary investors. And in the interest of the people, John's done quite a bit of research. John, can you lead us into what are the high points of this emerging story that we have mounting evidence that's continuing to increase? Every time you get another piece of evidence, it increases your level of concern, and you've gotten some official responses and a lot of official non-responses from those parties involved. So can you tell us what's the big concern, why people need to be aware at this time?
Sure. So it started in 2018 when I was doing a couple of videos about gold and the holdings of the Reserve Bank of Australia, which is Australia's central bank. So the central bank owns about 80 tons. The gold is physically located in the Bank of England. Back then, I was looking at the annual report of the Reserve Bank of Australia, and they said that they had been doing some gold leasing. They had leased about 11 tons of gold. So we did a couple of videos because there was rumors, and these are rumors that sort of linked to some research that Eric Sprott and some others have done, that the Bank of England was leasing gold to the bullion banks. That was being shipped to Switzerland. It was being melted down and being sold off to customers in East Asia, such as China in particular, but also in terms of India as well. So there was no transparency from the Australian government or the Reserve Bank of Australia about this 11 tons that was leased. So we did a series of shows about this in terms of this so-called gold audit. So in 2013, the Reserve Bank did an audit of its holdings, and that audit process was completely corrupt. The Bank of England didn't give us unfettered access to our holdings, and they controlled the audit process. So as a result of those shows, the Reserve Bank of Australia decided to release some information. So they actually created a web page with some additional information about their gold holdings, because our shows led to a flood of correspondence from our audience. Now, when it came to gold leasing, they did actually admit that they do engage in gold leasing, and they sort of gave some information about how the gold leasing rate is determined in terms of what the rental stream would be. But when it came to the counterparty, they clearly say, and you can still go on their website today, they say that that is confidential. And so for 2 years, the identity of the counterparty has been a big mystery. Now, what I can reveal in this conversation, and we just released a show with Martin North on In the Interest of the People. Last year, the Reserve Bank of Australia did an audit, like a 2019 audit of its gold holdings, and there was an Australian who put in a Freedom of Information request about that particular audit. A range of documents were released, and there's an email between 2 officials at the Reserve Bank of Australia in which they openly say in the email that the gold, so about 11.1 tons, has been leased to Gold Corporation. And Gold Corporation is the corporate name for the Perth Mint. And the Perth Mint is owned by the Western Australian government, so one of our state governments. So that's obviously a big piece of information. Now, why this is significant in a couple of aspects. So in February of 2019, there were some questions asked in Parliament to the Reserve Bank. So our shows on gold in 2018 led to some questions being asked in Parliament, and the Deputy Governor of the Reserve Bank, when asked about gold leasing, was emphatic when he said that when we lease gold, the gold physically does not move. So obviously there's been allegations that when gold leasing is done, that gold that is leased, that it actually moves out of, say, the vaults of the Bank of England. But the RBA's testimony to Parliament was the gold does not move. So the question you have to ask yourself is that, what is the business activities of the Perth Mint? It is to manufacture, to refine gold and silver products. And obviously, Andy is a big customer of the Perth Mint, but they also do trading, retailing. They sell at the wholesale level as well as at the retail sort of individual level as well. So if they're a manufacturer and a retailer effectively, why would they borrow 11 tons of gold that's in a foreign vault that physically does not move? Under the lease arrangement, they pay about 800,000 Australian dollars per annum.
Right.
So that's obviously the big question. Now, before I get to that answer, one thing I will say is that when you look at the annual report of Gold Corporation, and obviously, like I said, Gold Corporation is the Perth Mint, they have a line on their balance sheet called precious metal borrowing interest bearing. And this is effectively the precious metals that they have borrowed. So it is actually an entry on their balance sheet, and it's listed as a current liability. Now, they listed as of 30 June 2019 that they had borrowed $1.2 billion worth of precious metals from a range of counterparties, which they did not disclose in their annual report. Now, of that 1.2 billion, 700 million is this 11 tons from the Reserve Bank, but obviously they have borrowed another 500 million, so about $500 million from someone else. And we don't know if they've borrowed gold, we don't know if they've borrowed silver, we don't know who the counterparty is, and we don't know the location of that precious metal. So the question is, well, why are they borrowing this metal? And some of it is in foreign vaults that does not move. The answer, and obviously if Andy has a different explanation, I'm obviously happy to listen to Andy's explanation. But from what I can tell is about 2 months ago, I wrote an article on my website, on my Adams Economics website. It was a warning to Australians in particular about beware of synthetic gold and silver products. And we understand when people buy gold and silver, as in specific bars, specific coins, there's clearly legal title established that, for example, if I was to buy a gold bar or gold coin today, that would be my legal property. There's a range of products which are being sold around the world, and I'm sure this is relevant in the United States, but it's definitely relevant in the Australian market, where people believe they have exposure to gold and silver, but there is no established legal title. So these are things like unallocated, pool allocated, you've got ETFs, you've got gold and silver backed cryptos, and obviously with the COMEX, you've got futures contracts. So these are financial instruments where people think they have exposure or they have some ownership, but they actually don't. And so what investors have really bought in these circumstances is they've bought a promissory note. So they're basically hoping that the counterparty will be able to either give them back cash when they want to liquidate that position, or if they want to convert that instrument into a physical bar or a physical coin that the counterparty can actually deliver. And what I've noticed that in the Australian market is, obviously I deal in the bullion market myself, so I've been dealing with customers who have 6 and 7 figures in some of these synthetic products, and they haven't fully come to the understanding that there are counterparty risks when you don't actually have clear legal title established. And some of these customers obviously have been around the Perth Mint. And so some of these customers obviously look at the Perth Mint website, and the website says that our products are 100% backed by gold, by silver. So obviously if you ever want delivery is not a problem. Now, what I think some of these investors and customers haven't fully come to grips with is that the Perth Mint portfolio, if I could use that word, it's a combination of gold and silver that they physically own, that they actually have in their vaults. But also part of that portfolio is gold and silver that they've actually borrowed through these lease arrangements. Effectively, what we have is a fractional reserve bullion system where, obviously if there's a low amount of requests for physical, an institution like the Perth Mint can handle. But obviously if there's a run for a significant level of gold and silver deliveries, because they don't have all of the gold and silver physically in their possession, there's going to be an issue in terms of when certain customers want to redeem their unallocated positions into a physical form. And so that, I think, is a very significant issue, particularly for people who don't understand, the ins and outs of in terms of synthetic gold and silver. And I've listened to some of Andy's recent interviews, and Andy's with Miles Franklin has said that he's been seeing a lot of new entrants into the gold and silver market. I can say we've seen the same here in Australia, and a lot of people who have very little knowledge about gold and silver and some of the shenanigans that the industry has been playing with, they don't understand some of these nuances. And so obviously I think this is quite a significant revelation in the Australian context, particularly because the Reserve Bank of Australia and the government has been very opaque about who they lease the gold to. And obviously the Perth Mint hasn't been, and again, I should be clear, I'm not accusing the Perth Mint of illegality. What they've done is perfectly legal, but they haven't been, I think, fully transparent with their customers to say that, well, when we say that our products are fully 100% backed, part of that backing is gold and silver that we've borrowed, and we don't physically have that gold and silver in our possession.
Now, we've talked about the concerns around this for some time in the U.S. People have talked about the potential for rehypothecation, where if you don't hold it, you don't own it, is a mantra that people will share. And I guess, Andy, you can maybe share what you've heard being grave concerns that people have had about the availability of physical metals, for example, on the major commercial markets to satisfy people standing for delivery. And you've certainly talked about the increase in investors standing for delivery recently. So maybe you could bring us up to date on what you're seeing on this side of the pond from that kind of matches what John's concerned about from Australia's standpoint.
Well, yeah, I think what you said, John, makes perfect sense, quite frankly. Without knowing enough the inner workings of the Perth Mint to comment specifically, I'll simply say to you that we've always advised strongly against unallocated positions. An unallocated position is a delivery receipt in many cases. And so, I think you can really see it, that type of mentality being displayed on the COMEX market when you see family offices and high net worth individuals standing for delivery in record amounts. People, I think, are at a crossroads where maybe trusting the exchanges and trusting the institutions is, in normal times, something we take for granted. But in times like this, where counterparty risk creeps into the back of your mind, I think that's exactly what we're seeing. Now, I guess if I had to guess, commenting on what you had to say, the Australian government stands behind the Perth Mint. I mean, that'd be the way I would interpret it. And indeed, most everyone I've ever met in the industry who owns a Perth Mint certificate owns it in an unallocated fashion. I've only met one or two people in all the years I've done this that own allocated Perth Mint products. So maybe that's what's happening. Maybe there is a run on fabrication and delivery out of the Perth Mint, and they have to satisfy that. So that would be the only thing that would seem reasonable if what you're saying is valid, and I have no reason to believe it's not. But we're seeing that here too, and I think counterparty risk is going to be a central theme moving forward. Having physical possession in lieu of a paper certificate will take on greater and greater and greater importance moving forward. Absolutely.
John, you also mentioned ETFs as a vehicle that people participate in. That's certainly true in the U.S. as well. GLD and SLV are some of the most well-known. They're very highly traded here. They're very liquid. But there's always been concern, I don't know that it's ever been proven, but there's been concern about whether there's in fact the proper amount of 100% metal to back those, or whether there's rehypothecation of those shares.
What I was going to say was GOD. I think it's Rowan Manley from Bullion Star in Singapore. He came out with an article, I think in the last fortnight, in which he found documentation that shows that GOD has been leasing a certain tonnage of gold from the Bank of England. So obviously, even with these ETFs, when they say that they have ownership of gold that backs the amount of money that's been invested in these ETFs, some of it has been supplemented through leasing arrangements, and that obviously is a concern, particularly when people want to convert it to actual physical. And a couple of points is in terms of what just Andy said. So what we can tell from the Reserve Bank data is prior to 2016, the Reserve Bank was hardly engaged in any form of leasing. So these leasing arrangements with the Perth Mint are probably only 2 or 3 years old. So that'd be point one. And the other point I would make is that obviously when I've looked at what's happened in 2020, the key thing that I think really broke the COMEX and the paper market is the US Federal Reserve announcement of QE to infinity. And I think that spooked a lot of investors around the world to start to chase for physical. So I think when Andy talks about counterparty risk, I think that's a very important point, particularly going into the rest of 2020 and 2021, because obviously the central banks around the world are going to continue to print. There is no other possibility. Otherwise, this whole global debt bubble is going to implode on itself. And because I've heard in some interviews that Andy has given that it's very difficult to get large tonnage of gold and silver at the wholesale level. I dare say that as we go forward, that those shortages are going to become more pronounced. And when you have certain counterparties that have offered promissory notes in synthetic form, I think we're going to see a few big players around the world, maybe this year or next year, who won't be able to deliver the requisite gold and silver. And then obviously if you are an investor in that position, even if you get redeemed in cash. I mean, one of the things I've heard Andy say on multiple interviews is the spread between the paper price, the COMEX spot price, versus the price in the physical market. So even if you get redeemed in cash, you could potentially be still out of pocket, because had you had the physical metal and you wanted to sell that physical metal, you would have been able to make more money.
Yeah, a lot more recently, and there's potential for those premiums to be supported as the physical demand outstrips the physical supply. One of those things you mentioned in the article I noticed was this correlation that you were able to calculate between the publicly announced 11.1 tons of gold that the RBA says they are leasing versus the number of ounces that were mentioned in that leaked email that was leaked through the Freedom of Information Act inadvertently. Can you explain why that tied out so important to kind of corroborate those two data points?
Sure, yes. So in the RBA's email that was released in the Freedom of Information request, they referred to 0.357 million ounces. So rather than actually ounces, I think the email made a mistake. It should have been troy ounces, and 0.357 million troy ounces is 11.1 tons of gold. So the amount that they said is being leased to the Perth Mint is precisely the amount that they have officially said that they are engaged in leasing. That just sort of confirmed in my mind that there is only one counterparty. And the other thing I should say is that on the RBA website, they do say that when they do engage in gold leasing, the counterparty must either have a collateralized position that is either in Australian dollars or in a foreign currency, or has a government guarantee. And obviously the Perth Mint has a government guarantee from the Western Australian government. And so that's why the Perth Mint satisfies that criteria.
There you go.
Can we talk about what the impact, the upshot, why does this matter to the ordinary investor? Because in your article you mentioned like 3 or 4 potentially vulnerable parties or people who could be hurt by this. You just mentioned one a few minutes ago, and that is those who would like to have taken physical possession are going to have to be told perhaps, no, we're going to pay you out in cash, but that cash payment will not be at the market value of the physical you would have been given. It was at the spot price, which is significantly lower in the current conditions. That's one class of party. Who else might need to be aware of this and maybe take action if they're concerned about their vulnerability here? Yeah.
So in the article, I talked about different types of risk, whether it is the risk of overissuance of synthetic product, whether it's the rehypothecation, whether it is about the convertibility risk. So we're talking about roughly the same sort of risk, same sort of class of investors. But I'd be interested to hear Andy's thoughts about this. Is what I've noticed about the Australian market is that so prior to the last couple of years, maybe less than 1% of Australians actually owned gold or silver in terms of their personal portfolio. And so we are seeing a rush of new entrants into the market. Level of knowledge about gold and silver is quite low. My experience has been 99% of the people who I come across have very little understanding about how the price is set. And so this is where I've gone into some detail on my website about the difference between the London spot market versus the COMEX and how does the COMEX actually work. But also when it comes to the differences between owning physical and the importance of owning physical metal versus a synthetic product, there isn't a level of sophistication there. So particularly what I've noticed is large clients, 6-7-figure clients, they're very sensitive to cost. So they'll look at the cost, they'll look at the spread of getting in and out of a position. They're very sensitive around storage costs. potential insurance cost if they want to insure their precious metals. And obviously, one of the attractive elements of some of these synthetic products is that they have a lower transaction cost structure. And so that makes it more enticing for investors to engage in some of these products. But what some of these people haven't fully come to terms with is, yes, there are lower costs involved, but there are additional risks involved, and you've got to balance the two out. And so I think that's a very big signal that Australian investors and maybe even your audience in the United States also has to consider.
Andy, you've talked with us on recent visits about the examples of major clients standing for physical delivery or requesting physical. Maybe you can touch on that, and we'll circle back with John and what you're seeing, because you said you've also seen some major clients that are, once they understand this, once they grasp the risk that they didn't realize they were subject to, want to do something about it. Andy, can you first remind our audience of what's happening now? What's the big dynamic of the players that are getting involved and wanting physical?
Well, yeah, I mean, John, to your point, what that's called is penny wise and pound foolish. Worrying too much about transaction costs over having a stable, sound position. I always joke, I say, if things get bad, do you want stock in Kellogg's or boxes of Frosted Flakes? It comes down to, do you want the real thing or do you want the synthetic version of it? And I think people are seeing, even people who really don't know anything about gold and don't own any yet, they're looking at their stock portfolios and seeing the stock market at all-time highs with 50 million Americans unemployed. They're realizing that things are somewhat illusionary. And as that transition is made into physical metals, there's an awakening, a great awakening, that physical possession is really very important, mitigating the counterparty risk. One of the big issues that people will think about when it comes time to looking at one of the main differences between a paper form of gold and the real thing is the premium. And so, yes, it may be more cost effective. And yes, maybe the transactional costs are more effective. But one is an investment, that being a paper certificate, and one is wealth. It's been wealth for 6,000 years hiding in your attic or in a safe somewhere or in a hole in the ground in your backyard. It doesn't matter. It's wealth. And I think people are realizing when it gets a little scary out there that, maybe I just won't trust that institution, or maybe I don't trust that exchange, or maybe I don't even trust my statement on my portfolio. I think people, as I've said, this year means so much to so many people. I define 2020 as the Great Awakening, and people have awoken to many things. And as I've been saying, we've had over 2,500 new clients since the beginning of the year. Now that doesn't happen, you guys. That's an awakening, and all of those people. One of the central themes is physical possession. Now there is storage, and we do work with third-party storage facilities, Brinks and Dakota Depository, but in all of these cases, it's allocated and segregated. It's not pooled ever. It's not commingled. And if you can't hold it yourself, it better darn well be allocated and segregated in your name. And so there is a push all the way up from the top, from the exchanges, and all the way down to the retail investor, where physical demand and physical possession is what we're seeing, and I think we'll continue to see. Because quite frankly, there are reasons to maybe feel that the exchanges that we've trusted for a very long time maybe aren't as trustworthy as we've been giving them credit for. And rehypothecation is real. And so I think that would be one of my strong pieces of advice for people is get it in your possession, at least enough to feel safe with under your roof. And if you are going to relinquish some to a third-party storage facility, make damn sure that it's allocated and segregated in your name and not pooled. Because when the bell rings and everyone runs to get their unallocated metal, that first needs to be fabricated and then needs to be, put in queue with everyone else and then shipped across the ocean, you'll realize the difference between paying something for storage and having nothing. in terms of a storage fee and less transactional costs. What does it matter at that point? The answer is nothing. It matters nothing. So, nothing in the world worthwhile is free. Find a fair price and don't be penny wise and pound foolish would be my advice.
Thanks, Andy. John, you had mentioned that you've been in conversations with some significant-sized clients that are awakening to this risk that they didn't realize they were bearing. Can you share some of that in general terms?
Sure. So what I've tried to do with some of my articles is really just to provide my perspectives and to educate the market. And there are people who they've read my articles, and we've had some conversations, and I said that there are additional risks, and people have come to understand what those risks are. Now, there are some people who are happy to accept those risks, and there are some people who have come to the realization that they need to get physical. And so one of the things I've been trying to help some Australians is to make the transition from synthetic to real, so they may liquidate some of these positions in unallocated, pool allocated ETFs, etc., and then sort of come across with a firm that I work with and actually buy physical gold and silver, and either take physical delivery, or we have our own vaulting system, like Andy said, allocated in terms of segregated. So if Miles Franklin actually involved in themselves in that sort of process, helped people convert from synthetic to physical, that actually helps. That helps us in the long term in terms of part of the reason why the price manipulation scheme has been happening for so long is because of these synthetic products, because the purpose of these synthetic products is to divert demand away from real physical demand and supply. And so the more that we can get investors, even at the retail level, owning more physical demand and supply, it's going to exacerbate the shortage that we see on the COMEX and others, and that's obviously going to bring that day of reckoning forward when the manipulation scheme that does come to an end. And I should say, so today is Monday in Australia and Sunday in the US, and I think Thursday US time is going to be quite exciting because we'll find out how many contracts of the COMEX is standing for delivery in terms of silver for the September contract. And I think where we were about 17,000 contracts for July, about 84 million ounces was delivered. Listening to a number of people on the internet, we potentially could be looking north of 100 million ounces for September. And the big question is, do they have it? And if they do have it, what will the price, if they don't have it, what will the price have to go to for them to actually get it to actually fulfill these contracts? With these record deliveries on the COMEX, we are seeing some big problems around the ability to source gold and silver. And in the last fortnight, I've been privy to some conversations where some of the big international banks from New York have been making phone calls to places in Australia looking for 40 tons of gold. From the conversations I've been exposed to, some of these banks have got brokers. The brokers are making phone calls saying, our clients are looking for 40 tons of gold. And, calls being made around Australia, calls being made into Southeast Asia and also into China and Japan, looking for, a requisite amount of gold to fulfill, some of these orders from New York. And the gold can't be found. So, there was a request for 40 tons, and the most some of the parties could come up with is only 5. So there is a global race for physical gold and silver to meet these record deliveries on the COMEX, and the market is running dry of physical, and that obviously will create risks and issues in terms of the overall pricing scheme, but obviously that will cause some issues for wholesale and retail investors, particularly if they have synthetic positions with Perth Mint or any other institution around the world.
You mentioned in passing there about the meaning that it has when gold is sought physically, and we interviewed E.B. Tucker, an analyst from Casey Research, and he talked about gold is a truth serum. He says they can do all this, like you said, this illusion, or Andy said his illusion about the markets versus the real economy, that kind of thing. But the illusion comes falling down when people are going for the gold, because the price of gold breaking out as it did last third quarter of 2019 and basically not looking back since is evidence that the money is speaking, that it speaks louder than words, and it's breaking through to show that there's evidence of risk in the economy, in the fiat monetary system, in the banking system, and money is seeking a safe haven in gold. But there's a different element of that truth serum, which is people wanting the truth about where their ownership is, and that's where you're saying, quite interestingly, that if we can help people to convert out of the virtual system and into physical, it will expose, because there should be no problem with that, right? If everything's on the up and up, you should be able to convert out of the virtual system into the physical, and you shouldn't end up with a pinch. But it looks like there may in fact be a pinch, and we'll also put the chart in here when you're talking about the delivery months, and the COMEX have been, each month of the last several have been breaking records with versus the previous months as far as how many people are standing for physical delivery on the COMEX. And yeah, September is also looks like it's going to turn out to be another record up move in physical delivery requests. Andy, anything to add to what John was talking about being able to help people who have been participating in non-physical forms, trying to get some involvement in gold and silver just because somebody said it might be a good idea, but who want to make sure they have physical, how we can help them?
Yeah, I think for a lot of people, one of the big stumbling blocks is they feel locked in with financial advisories. One of the big things that people neglect to remember is the money inside their financial portfolio belongs to them and not their advisor. And the advisors will keep that money under their management for as long as they can, and they'll tell people to buy things, the synthetic programs like GLD and SLV. But here again, I just want people to think that, and this is how fast it happens. Like your broker trying to find 40 tons of gold and can't find it. Well, it starts up top and it will funnel its way down to the retail industry. When I've seen market shortages in years past, it happens within days, at weeks at the most. Happened in March that way. Silver price fell down to $11, 11 and change. You couldn't find silver for under $20. You couldn't get it for a long time because the mints shut down. These unexpected events happened. And we're entering a period of time where unexpected events keep happening. I live in the epicenter of unexpected events in Minneapolis. And so these things keep happening. And so it underscores the importance of physical possession. I'd like to say, the Perth Mint has been a godsend for my company over the last year. The product that I got from them really was fantastic. So on one end, they've been fantastic for me. On the other end, I'll simply say this, whether it's the Perth Mint or a program with any, let's just not even name names, any pooled account has its limitations and its drawbacks. And when things are going well, like anything, that's great, no problem. But when things get dicey and you want possession of your metal, that's when the fallacy is exposed. In GLD and SLV, as an example, a lot of people probably think that they can get their gold if they needed to, but you can't. You can't take possession of it. And with the Perth Mint product, in theory, it's redeemable, but you first have to fabricate it and then stand in queue and then have it shipped. The fallacy of being able to get it with any expediency is the important thing. And so I think people just need to ask themselves, is it important to have physical wealth, or do you trust it in a paper derivative? And that's really all it boils down to. And I think as we move further down the road, the relevance of removal of counterparty risk and of physical possession will have a price tag. It already does in the way of a higher premium. And when product gets harder and harder to come by, and more money is chasing fewer and fewer items, goes the premium straight up. And it's only going to get worse. So I'd simply just say this. In the end, I think people will do themselves a big favor by having physical possession. And without saying much else, I think that premium and that price tag is money well spent.
John, any further points that you want to make? And maybe I'll put links into the description of this video, folks, so you can get directly to John and his partner Martin North's articles about this. But anything that we didn't hit on here that we really should, to make sure that people have an understanding sufficient of this concern, John, that you have surfaced?
Sure. The only point that I'll make is, so I endorse all the comments that Andy just made. If people do want to make the transition from synthetic to physical, the earlier you do it, the better off you'll have the opportunity to actually get the physical. Because, like Andy says, as we go forward, the scramble for physical will intensify. It'll be harder to source. If you can get your hands on it, it will cost more. And so, for those who want to remove that counterparty risk, I really do think that time is of the essence. I mean, there is a lot of chatter about the September contract, what's going to do to silver. I mean, there are some big calls out there to say that we could see a $35 silver US or 50 or even north of 50 like over the next 4 to 6 weeks. So we'll have to see what actually happens in terms of September. But it will cost you more if you want to make that transition later. So the earlier you can do it, I think the better off investors will be.
One point I'd like to make, and this is the key crucial point. I saw it in 2008, and I saw it here in March. In 2008, the price of gold went from $1,000 to $700, and silver from $21 to $9, like that. In March, silver went down to $11.90. Gold was whatever, $1,200, whatever the number, or excuse me, $1,600, whatever the number was. Doesn't even matter. Point is that in both instances, when the paper price fell, like in 2008, down to $9 silver, you couldn't find an ounce of silver anywhere in the country for under 18. This time, with $10 silver or $11 silver, you couldn't find an ounce for 20. So the point of it is that if you're cashing out of your paper product when there's a shortage of physical, you're going to end up getting crushed on the premium trying to get back in. This is the divergence. This is the main divergence between the paper and the physical. And if you're going to do that, you have to act, because I think the trailing edge of the storm is not far away, and the election is coming, and I think it's going to get bumpier and bumpier. Time to do it is right now, while we're in the eye of the hurricane and it's still relatively calm, before premiums get, I think, only higher. So it's been good talking to you, John. I wish you well and continued success in what you're doing.
Thank you.
John, you never fail to amaze me on how much energy and tenacity that you put into digging into this research that you do on many different topics. And then you engage allies within the Australian Parliament, within the media where you can, and so on. Just grateful for your presence here, but primarily just grateful for the work that you are doing to surface and expose these important issues and these important concerns. So folks, please feel free to add your comments below this video. John Adams, economist from Australia, and Andy Schectman, CEO of Miles Franklin. Guys, thanks both for joining us here on Liberty and Finance.
Thank you.
Thank you, Dunnigan.
If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today.